Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. The next 25 odd minutes, we'll talk about two key aspects of mutual fund investing. Actually, we've split the show into two. The first, a lot of people are worried about what's happening in the world and whether Indian markets get impacted, and therefore should they become risk-averse investors. We try and dissect that with somebody who's looked at this very, very closely from that lens as well in the first half of the show. And the second half of the show, a lot of people, including people in my office, were clueless about the fact that there are very good options on the mutual fund side to get better returns for money lying idle in your bank accounts or money in fixed deposits. And we'll try and talk to two experts who will join us in the second half of the show to talk about that very aspect. But the first half of the show is with Aashish Somaiyaa, CEO of White Oak. He needs no introduction. He's been with us from the start of our journey when we were Bloomberg Quint and now BQ Prime. Ashish, great having you. Thanks for joining in. It's been a while, but good seeing you.
Thank you. It's always a pleasure. Thanks for having me.
No, the pleasure is entirely ours. Ashish, so that's the point. In fact, on our trade setups, on a bunch of our Twitter Spaces programs as well, or shows, or rather conversations as well, there's so many people who are talking about whether this is a good time to be risk averse. Now, my question to you is, you are launching schemes, you're going out and meeting people, you must be getting a pulse of what people are doing, and you've seen multiple such cycles. Do you believe people should be risk averse and diversify accordingly, looking at what's happening around the world?
Yes, Neeraj, I think over the number of years, I've seen that investors have become more and more discerning. They have, this is obviously people with experience. Well, we know the construct of our market is such that practically every day, every week, and every month, there are new investors who are joining the world of mutual fund investing and equity investing and capital markets in general. But over the years, I have seen that there is a critical mass for a larger number of people who are becoming more discerning, more experienced, and more seasoned. So, frankly, while we are discussing it right now, whether people should be risk averse or not, but if you really see the data and my interactions also, it clearly shows that people are becoming a bit more, cautious right now. Two or three things. I think one, obviously, the narrative on India at every level is seen to be positive, whether it's our economy or corporate performance. But on the other hand, if you see the global environment, I'm sure that's what you're quoting. So if you see the global environment, I don't think very many people are buying into the decoupling story a lot too much, right? Because economies and corporate sectors, one can always argue that we will have different levels of correlation or isolation. But as far as stock markets are concerned, beyond a point, maybe you fall less, or maybe you recover faster, or maybe you outperform. But you can't be really, you can do relatively better. But absolute numbers, you can see last 1 year, there's no return, correct? And October 21 was 18,400. But as recently as June 22, we were at 15,000. So that 18-20% was not a small number. So I think, yes, people should be risk averse. People should be careful and cautious. And I can already see it in people's behavior.
Okay, interesting. So just wondering, Ashish, I mean, I don't know, because you guys run a very large PMS and a large mutual fund business in the making. Just wondering, what is the house view currently? I mean, for people who want to be conservative in such times, I just thought of that question. I mean, for somebody who's a small cap investor, should he choose mid cap or flexi cap funds? For somebody who's a flexi cap investor, generally, should she or he choose large cap funds? And for somebody who's a large cap investor, should she actually move to the debt side because they want to be ultra conservative or conservative than what they usually are?
Yeah, so see, clearly everybody has a risk profile, and everybody has an asset allocation, or at least everybody should have an asset allocation which is in line with the goals that they want to achieve. And clearly that asset allocation should be devised as per the risk-taking appetite. So from that perspective, you're right that everybody is in a different position relative to each other, clearly. And when you look at your asset allocation, let us say you are somebody who is supposed to be 50% equity and 50% in debt. Let's take an example, right? And you find that in the recent times that 50 has become 60 or 65. because there has been kind of last couple of years things have been on an upswing. Last 1 year not so much, but clearly in the last couple of years people have made some appreciation. So if you are overweight, if you were holding money in equity but you had some loan to repay on the other hand, so one is at an asset allocation level, it is better that you are neutral to what your desirable weightage is. Hopefully in these kind of scenarios where we are talking about being cautious, you should clearly not be overextended. That is one thing. Like I briefly alluded, if you're investing at the cost of repaying some loans or something, then you might want to prioritize that. Coming to your other question, obviously, so that naturally dovetails with what you are saying, which is that if you are somebody who invests in equity regularly, okay, but then what you're finding is that you're not you think that it is time to be cautious, then maybe you should be in a large cap fund or a balanced advantage fund, instead of going at the extreme end of equity. You briefly mentioned that we are launching products at this point in time. Now, clearly, when we go through a whole regulatory process, and when we get approvals, we get products out. But our objective is always to beat our corresponding benchmark. We are not controlling individual investors' asset allocation. And when people are subscribing to any fund, we assume that they are self-advised or they're advised by somebody else who's helping them, whichever way. So we have to assume that people are taking care of their asset allocation. So when we launch a product, we are not going to take cash calls. As an equity house, our mandate will be to beat the corresponding benchmark. But on the other hand, as far as investors and advisors are concerned, they should definitely be mindful of what is desirable asset allocation on that.
Got it. What would be, okay, maybe it's a wrong question to ask because you run AMC, but if you had a choice to, as a retail investor, to put out an ideal asset allocation currently, it may be for a period of 1 year and then you may pivot towards either a more risky or even more conservative as the case may be, but under current circumstances, what would be your ideal allocation, Aashish?
Yeah. So, first, very briefly, I want to, since we are talking about caution and, being careful about asset allocation, etc., just to contextualize, why am I saying this and what is it that I'm thinking about? So just to contextualize, basically my worldview, or at least our worldview, is that, everything about India is great. We are not debating that. But our market obviously is operating in a context of an external environment. And the external environment is not as rosy. Different parts of the world have different reasons and they have their own problems, right? On a relative scale, we are looking better, but we are not fully, stock markets are not isolated. So basically, when so many parts of the world are in trouble, the chances that, some or the other risk could precipitate, some or the other negative news flow, some or the other impetus for a market correction. And like I said, as recently as June, we were 20% lower than where we are. None of those reasons have gone away and we are making new highs all over again. So let's just say that risks are rising and we should not be lulled into complacency. So what does this mean? What does this translate into as far as your question is concerned? I would basically say that today, when ultra short-term funds, and you briefly alluded, you are going to talk about this in your next segment, like you mentioned. So, short-term rates are at 6%. Today, ultra short-term funds, liquid funds are giving 6%, 6.5%. Ultra short-term funds, by the way, our running yields are somewhere in the range of 7%. You give or take 20, 30, 40 basis point expense on a growth option, and ultra short-term fund gives 6.5% today, right? So short-term rates have really gone up. Interest rates have gone up across the spectrum. On the other hand, we already discussed about equity. So if it was my money, what I would do today, I would park all that money in an ultra short-term fund. On a running basis, 6 months back, it was giving barely 3-4%. Today, it is giving 6.5%. So I would park all my money in an ultra short-term fund, right? And I would register a systematic transfer over a kind of slightly long-run systematic transfer. So usually people transfer money 2-3 months. But I would register a systematic transfer, put money in an ultra short-term for next 6 months, and drip the money over 6 months. Or if there were to be a correction in the market, let's say we were to go back to 15, 16,000, then I would kind of accelerate the moves. So if it is my money, this is what I would do. Put it in an ultra short-term fund and then see how to drip it into equity, depending on what type of opportunities are available. Because I don't see much, fundamentally not too much is going wrong right now, but just that the external environment could give us some kind of corrections along the way.
last question, Ashish, and which is uh, if you had a chance, and I know funds, funds, houses have their own philosophy. You may not have a philosophy of a thematic fund. There might be a lot of time between what a regulation permits you versus what you can launch in an ideal time. But like you mentioned, that external environment is not looking that great, but India seems to be doing okay. There are some right notes that are being hit, etc. If you had a choice of a thematic fund, Ashish, where is
Mhm.
it that you believe your house would launch a thematic fund?
Yeah, I think that the whole financial space is one. Okay, it's kind of talking about banks and all is beaten to death. I'm not debating, not discussing that. But the broader sense of financials, everything to do with capital markets, whether it is exchanges, RTAs, depositories, wealth managers, asset managers, the whole space. Because I think that is what has changed dramatically in the last 5 years. And I think for the next few years, that is what will continue to accelerate, according to me. That is one area. Second thing is, if you really ask me, consumer durables or discretionary. Because, see, look, when we are talking thematic, we are not trying to, it wouldn't make sense for me to say, okay, IT has underperformed a lot, and I think next 6 months it will outperform. Because I imagine that when you and me are talking thematic, we are not talking about a 6 month mean reversion kind of thing. So we are definitely talking, at least a fund which will, we don't need to close it in 3 months or 6 months,
Yeah, sure.
which will go on for the next 5, 10 years. Then I would say that, beyond banks, the broader financial and consumer discretionary, I think these are two areas which are maybe sustainable.
Great. Ashish, it is always lovely talking to you and great. So today as well, thank you so much for taking the time out and being with us. And you should come more often on our platform.
Thank you. It's my pleasure. Thank you very much.
Really appreciate it. Well, that's the view from Aashish Somaiyaa, CEO of White Oak, and they are a very large portfolio management services house, any which ways, and have launched a few things on the mutual fund side as well, and some views around risk diversity and managing risks within your portfolios as well. If you indeed you are a conservative person, and maybe you need to be. We're going to add this conversation with our next two experts who join us on the show right now as well. But we've chosen a slightly different theme for them simply because a bunch of people have spoken about what to do in those scenarios. And therefore, the scenario is this. There are a lot of you who have got money which you need maybe 6 months out, maybe 12 months out, maybe 24 months out. Some of you have fixed deposits which are not necessarily at the brightest interest rates. And therefore, you are clueless or maybe clueless about what are the options out there to give you a slightly better bang for the buck, which compounded over a period of time would actually become meaningful. And therefore, we thought it's best to revisit this topic. It's always a good story is always worth repeated, and that's what we're trying to do today. With two experts who will try and educate us on that very particular thing. Poonam Rungta, CFP, as well as Anant Ladha, founder of Invest Portal. Anant has been on our show a number of times. So Anant, great having you once again. Thank you for joining in. And
Always
Poonam,
my pleasure.
no, seriously, great having you. And Poonam, we're talking for the first time, but we look forward to this show.
My pleasure.
Yeah. Okay. So I'm gonna dumb down myself and think and present myself as someone who's just graduated, and therefore going to ask some very basic questions because I think that will help our viewers a lot. Ladies first, Poonam, I'll start with you.
Yes.
For somebody, or let's say I'm using myself as example, Poonam. I have some money which is which I need, which I don't know whether I'll need immediately or no, but it's lying idle in my bank account, and I want to invest for a very short term. Now, can you define what these short term would mean from a mutual fund perspective, the products available, and what are the kind of returns that people can expect from this category or these categories?
That's a very valid question, and a lot of investors have this kind of confusion in their mind. First of all, everybody thinks mutual fund is only for equity, which is not so. Mutual fund is in fact a core product where you have exposures to every investment avenue and every investment opportunity which can be seen in a financial market. So when you talk about short term, people usually jump to the fact that oh, I need money only after 3 months, so let it be in a saving bank account, or maybe do a short term FD and generate some returns over there. But here I would like to point out, like you said, let us start like a layman, so There is an option in mutual funds also. We have a debt category, 100% debt. Just like how you will invest in a bank saving account, not invest, sorry, park. I would use the word park. You park the money in the saving account and not bother so much about the interest rate. Just keep about the safety of your investment. That my capital is safe and I can use it whenever I want. So similarly, we have products in mutual funds. We have short maturities which are safe. They're not subject to interest rate fluctuation. So if you have a horizon for say 3 months, yes, we have a product. We can park it in liquid funds. We can park in ultra short products where there is no exit load, where there is a quick flexibility. You redeem today and you get the money in T+1 day or T+2 day maximum. So these products invest in the investors' money in the products which doesn't have interest rate fluctuations, like treasury bills or commercial papers and market papers like that, which have very short maturities. They are not subject to interest rate fluctuations. So that kind of product are available, in which if an investor park their money instead of keeping it in a bank saving account, you can generate more returns than bank FDs, which is like, even if 1% or 1.5% you are able to generate more, it makes some sense. In the same way, going forward, if you have, so first of all, in mutual funds, it is very important to understand that time period which you have in your hand.
Sure.
If you can foresee that your money is available for 3 months or 6 months or 1 year, it helps better to have a specific arrangement to park your money. So from there, we can take it from ultra short term or liquid funds to, little bit bond funds or medium term or something like that, which can generate better returns in the period available to an investor.
Got it. Anant, you want to come in and try and maybe I would love it if you can be a bit more specific as well for people who have money for, let's say, less than 3 months, but up to 6 months, and up to 1 year, because I believe over 1 year, that's a slightly longer term horizon. What are the kind of options available? What are the kind of returns that can be expected?
See, firstly, randomly saying that mutual funds or some debt products are always better than flexi FDs and FDs, I think it is a vague statement. We have to see the overall scenario. In rising interest rate scenario, if your money is for ultra short term period, even flexi FDs are a good option and it's absolutely okay. But looking at where we are today, I am trying to give some options. If your time horizon is below 6 months, ultra short term category is something which I am attracted towards. Instead of liquid fund, I am choosing ultra short term as a category because their YTMs, that is yield to maturity, that is the interest rate at which those mutual funds have given money ahead, is comparatively higher. Right now, we have YTMs of somewhere between 6.85 to 7.35 in ultra short term category, with modified duration of roughly 0.30 to 0.40, which is still okay. So for below 6 months, this is a very interesting category. If you have a time horizon of 6 months to 1 year or 1.5 years, we have two categories in that time horizon. Firstly is arbitrage fund. Especially if you are a person who is paying interest at maximum rate, arbitrage fund can be a very effective way of getting equity taxation, plus getting effective returns of somewhere around 5 to 6%. And second category is floating interest fund, where presently YTM are somewhere between 7.25 to 7.75, and modified duration is roughly around 0.50 to 70 range. So these are three options which we have.
Okay, Anant, I would presume that the taxation in each of these is non-equity taxation, so 30% tax?
Yes, according to tax slab.
According to,
except the arbitrage fund.
Okay, in arbitrage fund, it's an equity taxation.
Equity taxation, yes.
Okay, which would mean that in the short term, you're paying 15%.
Makes sense. Absolutely right.
Okay, great. Now, to both of you, I would urge, if you can give us some examples of funds. Again, let me clarify, viewers, that these need not be the only fund recommendations that they have. This need not be an exhaustive list. This will more be an indicative list that both our advisors might give. But it will help our viewers a lot if you can share some examples of fund which people can then go up and look up and try and study and see. And of course, if they need more help, they can reach out to their advisor or you guys. So Poonam, I'll start with you. For the two categories or the two options that you mentioned, which is either liquid funds or ultra short-term funds, are all houses giving almost equivalent products, or are there one or two which are doing a good job and you might be indicative of them?
Mostly all fund houses have this category of funds in the debt category. So you can choose a good fund house which has got a good rating of their funds also. That's also equally important, where the rating of the papers held are of good quality. Then only you get more secured and you are more sure of the good returns, because even the debt funds, whether we are sure that capital will be safe, they are also subject to the interest rate fluctuations. So you have to choose the funds which has got good track record and good papers in hand, because we've seen in past how franking papers busted and how things went wrong in a good fund house also. So I would recommend in the liquid category, you can go for ICICI liquid fund, or you can go for Reliance Nippon liquid fund, or maybe Aditya Birla liquid fund. You can go for those. And for ultra short term also, I would recommend all these three funds. And also you can look at for DSP mutual fund and Axis.
Got it. Thank you so much. Anant, you added a couple of categories out there. One of them was arbitrage. Now, this has got an equity angle to this as well. Are there some fund houses which are doing a good job? Again, like I said, like I mentioned for Poonam as well, not an exhaustive list, not the only recommendations that you have, but good indications.
Do you want me to cover ultra short term and floating interest category as well?
Yes, please, Anant, do that.
See, whenever I'm selecting debt funds, my simple criteria is, first is safety. We have to see that to whom are the fund house giving money to. Secondly, what is track record of the fund house. Secondly, we have to see liquidity, which means that size of the fund. I want big size fund, especially in debt fund, so that there is no liquidity issues. Third, I look at returns. Returns is third priority when I talk about debt funds. Firstly, if I talk about ultra short-term category, there is a fund which has 10,000 crores of plus stable fund, which is ICICI Pru Ultra Short-Term Fund. So that is one fund which I like in that category. Second fund can be Kotak Low Duration Fund. It can be used when our time horizon is from 6 months to 1 year. If I talk about arbitrage category, Tata Arbitrage Fund has of lately done really well, and their AUM has also increased, and they have a sizable AUM of 6,000 crores plus stable fund. So that fund is very good, especially because it has low tracking error. In arbitrage fund, we have to see that our fund house or the fund is not having high tracking error. So that is a fund which I like in that category. In floating interest, if I talk about few fund houses, obviously ICICI is really good. Even HDFC is good in that category. Low duration fund, they have really good low duration fund. And third can be Kotak Low Duration Fund. Okay. YTMs more or less are same amongst all the three fund houses. HDFC is slightly lower, but ICICI and Kotak are almost same.
Should viewers or readers, should either of you or should any of you be wanting to or thinking of investing into the funds that have been mentioned, I urge you to please do your own bit of due diligence as well. Yes, our advisors are learned people, that's why they're on the show. But still, it will help if you do your own due diligence as well, if you go out and invest into these funds. Though the debt category, unless an anomaly happens like the way Poonam mentioned, should relatively be giving constant performance. Now, for a time horizon which is northwards of 1 year, but up to 3 years. Again, viewers, why I'm choosing this time horizon is because the taxation structure would probably still remain the same. Over 3 years in the debt category would be a separate tax structure versus before, so up to 3 years. And Poonam, here's my question again to you. For people who want to invest with time horizon of over 1 year for sure, but are not confident of above 3 years, what are the options? What are the kind of returns?
Again, in this category, looking at the current market scenarios and the high volatility, I don't think that pure equity exposure is recommended.
Most certainly. So we're talking about a bank replacement, so it has to be fixed income.
Yeah. So for that, I would like to go on and for the investor to take a little more risk of debt market, so they can go for bond funds or they can go for very conservative funds again. But the maturity papers which the fund house will hold has to be a little longer. They can benefit also in the long term, but of course they are vulnerable to the interest rate risk in long term. But the bond funds, where the diversification of the holding of the fund house is more so the investors' money is safe. They can look at bond funds because corporate FDs give more returns, more interest than the bank FDs, which investor can benefit from, or they can go for medium-term funds where again the maturity, the difference is between the maturity of the papers held by the fund house. So they can look at that.
Okay. Poonam, just one quick follow-up. There is a lot of conversation these days about target maturity funds. Do these become an option in the 1 to 3 year bracket?
Definitely, like which you call FMPs, fixed maturity periods, they can be looked at it. The yields are certainly better than the bank FDs, but again here there is a lock-in period. If the investor is not sure how much period he has in hands, then he may get little caught up between the maturity. So if the investor is sure of the maturity period, then he can definitely look at those.
Okay. Anant, your thoughts? 1 year to 3 year period?
See, if our time horizon is between 1 to 2 years, then floating interest
1 to
rate
3
funds.
years.
1 to if firstly I'm dividing it in two parts. If it's below 2 years, floating interest rate fund will solve your purpose. If it is more than 2 years, I like a category. Basically, I like accrual based debt funds. I don't like to take a call on duration because that is something which
Would you
can't take.
Simplify this, Anant? Would you simplify this for our viewers?
So I want a fund where duration of that duration of the papers which that fund is holding is almost equal to the time horizon which I have. But instead of it, if I have a fund which has duration much higher than the time horizon for which I am investing, there comes the interest rate risk. What is interest rate risk? It is directly linked between modified duration and the interest rate which is going on in the economy, and it is inversely proportional. Suppose if interest rate goes up by 1%, whatever is your modified duration, your returns will reduce by that percent, roughly. It is a rough calculation which I have. So I like credit risk fund in this category, especially between 2 to 3 years or 2 to 4 years. I like credit risk fund. It is comparatively risky funds, but it is pure accrual based funds. And if you are using a somewhat stable fund houses, I think it's a good category to work with, provided you know that what risks come with credit risk funds. In bonds funds, that is a good category, but duration is slightly high. So I usually prefer credit risk fund over long-term duration funds or bond funds. That is my view.
Just one question, Anand. This is as a replacement for money which is lying in the bank. Are credit risk funds a good option for that or such a need?
It is slightly risky, but yes, if we are choosing a fund house which is not giving more than 7 to 8% money to one party, plus we are choosing a fund house which has stable record in past, plus paper quality is slightly comfortable. See, my first thing is that I want safety. So in credit risk fund also, we have some funds which are comparatively safer because they are not taking or they are not running after returns. So in those type of funds, I think we can choose and we can take an aggressive call. I know it is not for everyone, especially after the Franklin thing, but just because of one case, we cannot completely ignore the complete category, which provides you stable accrual-based returns.
Okay, so actually, I'll repeat to you and then I'll go to Poonam. What are the some examples, since you mentioned that you to choose fund houses which have had a good track record, etc. What are the credit risk fund options? And of course, the other category that you mentioned, options out there too.
Credit risk, I have 2 fund houses and 2 funds in mind. Firstly is HDFC Credit Risk Fund, a very stable fund. They don't have high YTMs of 9 or 9.5%, but they have stable YTMs of 7.6 to 8.1%. Second is ICICI Credit Risk Fund. Both these funds have had a superb track record and are comparatively stable. And the fund managers are also having a good track record with managing debt. And in floating interest category, same funds which we were using earlier, that is Kotak Low Duration Fund and ICICI Floating Interest Fund.
Okay. Poonam, I'll come to you. You were of the opinion that in certain cases, if the person knows about the duration, then target maturity might be a good option. But otherwise, you were going with the bond funds largely. What are the examples and what are the kind of returns that a person can make here?
In a dynamic bond fund or corporate bond fund category, they can move, they can get interest up between 6 to 7% very easily. And depending on the interest rate fluctuations and the corporate structure, they can make more money up to 9% as well. I would recommend a HDFC corporate bond fund in the category and also Kotak Bank.
Okay. And what about target maturity, Poonam?
Target maturities keep coming in the market. They are not open-ended. They have to be, looked upon. So SBI has got good fixed maturity plans coming in over and again. So you can look at SBI fixed maturity.
Great. Poonam, final round, and that is on somebody who's got a fixed deposit, let's say 4 years duration or what have you, or beyond that, and is looking for options wherein she can earn better returns with an almost equivalent amount of safety. Is there an option in the mutual fund side?
For that, my all-time favorites are saving funds, where they have very small proportion of equities, where equity proportion is as less as 20 to 30%. They can get equity participation as well, because the time horizon is more than 3 years and the investor is conservative. They can take 20 to 30% risk of the market, and the rest of the money is in the debt fund. They sometimes categorize between arbitrage also and debt funds also. So arbitrage, again, as Anant pointed out, has the equity taxation. So the whole scenario works very well with the mutual fund investor who are looking for a 4-year.
Okay. What are the kind of returns that one can expect from such funds?
I have seen the recent past interest, the return going up to in double digit, more than 10%.
Okay. So these are equity savings funds you mentioned.
Yes.
Okay, great. Thanks. Anant, same question to you. Duration over 3 years.
I think if you are looking an alternative of FD, medium-term funds can be a good alternative, and some portion of credit risk fund will also work in this category.
Okay, what are medium-term funds? Sorry, they invest in.
They have slightly higher duration, somewhat above 2.5 to 3 years, which is almost matching to your time horizon. Stable portfolio, comparatively decent size of AAA funds and AAA rating parties to whom money is given, and we can expect somewhat stable returns of 7.5% to 8% with taxation benefit, obviously.
With taxation. And can you just explain that, the taxation benefit, because you're not mentioning about an equity product at all. So what is the taxation benefit? Can you mention, because our viewers would love to know that.
See, normally in FDs, taxation is almost equivalent to whatever tax slab you are in. In debt fund, whenever your time horizon is more than 3 years, you get indexation benefit. That is, your cost is getting increased with the rate of inflation index, which government is releasing every year. So because of which we can say that effectively your taxation is almost 20% as compared to what you would be paying in normal FDs.
Got it. Viewers, just so that you don't get confused, what Anand means is that your cost doesn't actually increase. Your notional, your actual buying price remains the same, but the price at which you are considered for taxation is much higher than your actual buying price, and therefore the profit that you make is relatively lower than your actual profit. And on that profit, you pay the taxation, which is what Anand was referring to. Anand, thanks for that option as well. And Poonam, may I come to you for the names? So what are the funds that you've seen have done a good job in the equity savings category?
Kotak Saving Funds is one fund I will highly recommend, and you can also look at ICICI Savings.
Okay, and Poonam, you are comfortable recommending these equity savings fund for somebody who's wanting a replacement purely for monies which are lying in a bank or a fixed deposit?
Again, it will depend upon the risk appetite of the investor, because it does have a little bit of equity portion into it. But because you're saying more than 3 years, then I would really want my investor to park the money.
Okay, you would do that with your money?
I will.
Okay, great. Okay, and then the final question to you on this show, again, examples of the fund houses or the fund schemes.
I would give an important disclaimer. You might see that almost fund houses are getting repeated, because whenever we are selecting funds in debt, we want a stable fund house which has high AUM. That is why we are seeing repetition of fund houses. No hard feeling to any other fund house. In this category, first, SBI has good fund. Medium term, ICICI, Kotak, HDFC, all 4 fund houses are having stable size, good medium term funds.
Great. Well, this was really educative. Both of you, thank you so much for taking the time out and being with us on the show and giving us such lucid explanations around what people can do with their fixed income investing, so to say, via mutual funds. Poonam, Anant, thank you so much.
Always my pleasure. Thank you so much.
The pleasure was ours. Viewers, thanks for tuning into this leg of the Mutual Fund Show.